Federal Reserve leaves rates unchanged. Let's talk about it on the weekly update.
Okay, friends, let's talk about Fed Day. Here's what you need to know. First up, the Fed didn't move on interest rates, but tariff impacts have started to show up. And what I'm talking about here is the SEP, the Summary of Economic Projections that the Federal Reserve puts out. And basically, if you look at these numbers and you were to crunch them, we're starting to see some impacts of what a tariff might do to the US economy. And to my eyes, we've got basically, if you compare, where they are from December and where they are today on things like GDP, unemployment rate, PCE, you're starting to get a little flavor for what these tariffs and maybe these trade war sort of sentiments are going to do. And basically, GDP goes down a fair amount. There's a little bit higher unemployment, but not too much. And then certainly where it's most pronounced, we can feel it in PCE, which is inflation. And despite all of these impacts, you might say, hey, this might change the Fed's sort of forecast. If we go down here to interest rates, everything has really stayed the same. And so the Fed is sort of hedging its bets here. It's sort of saying, hey, we see some impacts from these tariffs, but the reality is no one really knows. The 2016 tariffs that we placed on China, for the most part, China just ate those. This new fight that we're going to go through on April 2nd, it's hard to know which way it's going to go. And so I think what you're seeing here is some conservatism where the Fed is saying, hey, we're going to keep our interest rate guidance. And these are some impacts that we might see happening, but I would expect all of these numbers to start to change drastically as we go through this fight. One other thing I think that's going to be supportive of assets. So everything that you saw there was pretty dour, more inflation, less GDP doesn't sound good, but they're leaving the interest rates alone. Here's one that's positive, and they just sort of like threw a bone to the market. The quantitative tightening that the Fed is doing right now, which is allowing their balance sheet to run off, they marked it down in a big way. So they're talking about the decline in their securities holdings by reducing the monthly redemption cap on treasuries. This is basically how many treasuries they're allowing to fall off the balance sheet. They're basically adjusting it in April from 25 billion to 5 billion. So what they're doing here is they're tapping the brakes a little bit on reducing their balance sheet. And what this is going to do is this is going to put some more liquidity into the market and generally should be pretty positive to asset pricing just about across the board. So this is interesting. And so you see the Fed has a little bit of cold water on the tariff impacts, but then they're giving us some gifts here on the quantitative tightening impacts. And what this all means to me is the Fed is hedging its bets right now. The reality is no one sort of knows what's going on or how this tariff situation is going to unfold. And so the Fed is just getting ready for, whatever is coming. As for the market, let's take a look at the market. As you know, my expectation was we were going to come down to the 200-day, close maybe 3% below it, log a correction. There's going to be very high panic and fear, and then we would bounce from there. And maybe as we get towards the back half of April, things will start to look better once we get past options expiry, the tariff day, and the tax deadline. Those are the three big dates that I'm watching. And if you look at where we are, it almost looks exactly like that. Now, I would prefer more of a market bounce after that 3% below the 200-day. We aren't getting that. Volume has been really anemic. And what this tells us is everybody's waiting for reciprocal tariff day, which is April 2nd. So what does it all mean? Fed hedges its bets. Well, the Fed has left rates unchanged. That was as expected. The Fed has begun to price in a prospective trade war, and you can sort of see that in their expectations for inflation and GDP. Reducing the pace of balance sheet runoff should be supportive of markets. So they're giving us some positives here, and they're sort of like, preparing their forecast for some storms. What I would say from here, though, with the Fed out of the way, all eyes are now on the March OPEX, which is March 21st, and Reciprocal Tariff Day, which is April 2nd. And if you know how those are going to go, you're a bit smarter than me, I would say. To my eyes, I think the market is really hedged here at this point. We've priced in a lot of worst case scenarios, and I'm seeing the Fed do a little bit of that here as well. It's pretty significant, the changes that they made. And so what that tells me is if everybody's braced for pain, then I'm actually not all that worried. I think we're going to get through this process just fine, but we'll see. It's a live event. And if I knew what Donald Trump's intentions were, I'd have a lot less wrinkles, I think, right now. So there you go. That's the news news review. You know, we've got some big events coming up March 21st, April 2nd. And then I think as we get towards the back half of April, I think a lot of this alleviates because we're going to have certainty on all of these things. Finally, I'm not surprised that the market is taking it the way it has. But if you look at what the market has done around its 200-day, it tells us that we're still alive here. See you this weekend for the markets review. Take care. Okay, friends, that was the video. Hope you liked it. If you found it informative, good, entertaining, I'd love if you could scroll down here beneath the video and give me a like there. It helps us out with the algorithm. And then if you want to be notified first of anything new that we upload to the channel, if you come over here, click subscribe, you'll be the first to know as soon as we upload anything. Appreciate it. See you soon.